analyst. It was my portfolio manager and myself. I had to follow about 25 stocks, and I was basically forced to know them inside out, like the back of my hand, keep on top of all the macro news, client calls, meetings, institutional analyst meetings, whether the topic was semis, which Seifel will touch on later, cloud, tech hardware, oil, gas, etc. I never truly felt like I had an edge in any one single name there, covering 25 names. So on the side, I started devising my own personal strategy of telling myself, I don't think I can own more than 10 names at once, because I felt like it was, I had an informational overload and I was unable to make quick, rational decisions based on the data I was presented with or the data that I found. I'm pretty sector agnostic. I just find myself in tech more often than none, because I love reading about the businesses and challenging myself to learn about them. Cloudflare is a company I never thought I would have come across if I didn't branch outside of other industries. To me, as you increase diversification above 15, 20, 25 names, however you want to define diversification, I feel like you have the risk of potential lower returns, future returns. And when you couple that with the research and due diligence that you have to do, it really takes time to fully build a thesis. And if you're covering too many names, you might start to potentially lose the informational quote unquote edge you might want to gain over others. I know for myself, I can take at least a full month of research and truly dive into a name and then figure out if I want to own it or not. I think 10 names is a great amount to follow for a single person, maybe even if you work a normal 9 to 5. Um, Obviously, we have investors like Peter Lynch, where that wasn't the case, but I'm not Peter Lynch. I'm Chris from Fiducia, and I'm 25 years old. So I think sticking to my core discipline is something that is really important. Portfolio concentration can also revolve around the individual's risk tolerance and their personal financial goals. I mean, you're not going to have Billy, who's 55 with $5 million, who wants to retire and produce income. They're not going to invest in the 4 software businesses that I plan to own for the next 10 to 15 years. They're going to have income and allocate differently. So markets are vast and the opportunities are endless, and we all have our own goals at the end of the day. My portfolio is just a lot more aggressive than the normal person, given my age and time frame and where my interests lie. There's obvious tail risks with this. Um, I always make sure that the balance sheets are strong. There are no liquidity issues or potential bankruptcy issues, and you can check this by the Altman Z score, which is one of the first things I sort of look at. I just finished reading The Little Book That Beats the Market, and I don't know why it took me 7 years to finally read this book, but the one quote that stuck with me through that whole book, and I think everyone will find solace in this given the tech quote unquote sell off, is Mr. Market is subject to wild mood swings. Each day, he offers to buy your share of the business or sell you his share of the business at a particular price. Mr. Market always leaves the decision completely to you. And every day you have 3 choices. You can either sell your shares to Mr. Market at his stated price, you can buy Mr. Market shares at the same price, or you can do nothing. During the tech sell off, we were buying and sort of doing nothing because of the long term view on the businesses that we own. I think another tail risk is having a sense of overconfidence in your business, and that could lead to irrational decision making. I know I tout Cloudflare a lot on my feed, and I don't want that to be mistaken for overconfidence in the business. So one day I tweeted, "What is the bear thesis for Cloudflare?" I mean, I need a good, solid bear thesis that maybe isn't necessarily valuation. Or there are holes in the business. So what can go wrong? And it kind of blew up. Even Matthew Prince and Muji from Hypergrowth responded to it, and they basically said they liked the thread. So understanding where you can improve is critical to becoming a better investor, in my eyes. Uh, my research has led me to this type of portfolio concentration: no overconfidence, no bias. Basically, I was taught to throw my emotions out at the door and sit in the cockpit and trade. That's what I was taught and conditioned to do. Personally, I have no interest in investing in my 12th best idea. It's my 12th best idea for a reason. I'll take my top 5 to 10 and stick to that, really dig in, talk to people in the industry, Some of the greatest investors of our time loved portfolio concentration. Buffett, Munger, Greenblatt, Claremont, Druckenmiller, and notably Ackman. Ackman has like 10 or 11 holdings. I love that. I absolutely love that. You get my point. I think what can make an investor unique is when they can eloquently explain what they own, why they own it, and where they see the business going in basically less than a minute. If you can't do that, I don't think you really understand your business well enough. The ability to distinguish fact from noise is imperative to proving how much you know about the business as well. One issue that I ran into covering all those names was news flow. So I like to really drill in on news flow for portfolio concentration. Studying a smaller basket of names for me helps my focus and my ability to retain information. And I think retaining information is probably one of the top catalysts to being a great investor, is being able to spit out what you've learned. You don't want to just regurgitate what a 10K says. You want to be able to digest that information and turn it into a thesis. So when I was studying 25 names, I felt like I was all over the place. And I'm hoping someday that I can hire another analyst for Fiducia down the road to branch out into another 5 to 10 names to broaden the portfolio. As investors, we're not dealing with certainties. We make assumptions, hopefully educated assumptions, when we put our capital to work. And making too many assumptions on a daily basis clogs my personal thinking, and it scatters my brain all over the place. I have to force myself to remain focused on my core responsibilities and businesses that I own. Owning sub-10 names, sub-10 names, I feel can lead to outperformance of your relative benchmark, whatever that may be. If you truly know what you own, you start to see how the name reacts to specific news flow, reports, analyst upgrades and downgrades. And I think that's one of the best parts about really knowing your businesses is you start to get to know the analysts that cover your name. So if they start talking bearish on it, but you find conviction in their price targets and their financial analysis, you can basically take that information, use it as a data point, and use it to see if you have to sell the stock or not. I run 2 portfolios, one long-term, so I can focus on the research. And this year I've been really focused on lowering the turnover in that account. Last year it was very high, which I'm doing a great job of that this year. And then I have one active where I trade stock options, and I basically try to maximize every opportunity that is thrown at my face. I let the trades come to me, and I don't go to them. I let them come to me. The website members know that. And with that, I think I can finish there, and I am looking forward to see what everybody else has to say.
Awesome. Thanks, Fiducia. That's really helpful insights, and I don't hold your age against you. I'm not an ageist.
I mean, I've personally found that there's a little bit of ageism in the industry, but
of course there is.
It's
whatever. I think a lot of us that started younger in the business probably did experience that, but so is life. But we wanted to ask you the same question we're going to ask all of the speakers. In your was it set 9 years now in investing, what is one of the biggest lessons that you've learned, and something that everyone else can take away from this?
So this is going to sound kind of basic, but John Maynard Keynes, the market can remain irrational longer than you can remain solvent. I would replace the word market with valuation. I think selling based on valuation for me has caused me excess returns that are gone. And I use the example of Square all the time. I bought in March 2020 at $39 a share, and I sold at 93 because I thought that was sort of fair value for them. And look at where it's at now. So I think being subjective to valuation is very important. Obviously, you need to run valuation models, but at the same time, take it with a grain of salt. Use it to understand the financials, run some sensitivity analysis, but there's a lot more driving factors at the end of the day.
Yeah,
absolutely.
No, completely.
Anybody
agreed.
hear me? I feel like it just gave out.
Yeah, no, we're with you.
Okay.
Yeah,
valuations can
I think that's a common
irrational.
theme.
That's for sure.
Yeah, I think it's a common theme that I've heard a lot of people talk about, the struggle I think we all deal with. And I forget what the study was, but essentially it showed that all active managers are really good at buying, but terrible at selling. And
100%.
so you're not alone.
That's a great point.
Yep.
Thank you, Fedusha. That was great. Max, back to you.
Yeah, absolutely. Thank you, Fedusha. Great talk as always. Thanks for sharing your knowledge. I really appreciate it. And let's keep moving forward. Next is Caleb. He's undergrad in finance from Minnesota State University. He's experienced data management and reporting and advice in wealth management. We all know Caleb. He's been sharing a lot of knowledge in the FinTwit community, contributing pretty much on a daily basis. So without further ado, Caleb.
Thanks, Max. Yeah, I've been active on FinTwit for, I think I really started engaging more in 2019. I dug back through my tweets and it really kind of started, I think, the end of 2019. And I had engaged with a couple of people that were growth tech investors at that time that have really helped me along the way. But yeah, more or less, I I work in advice and wealth management. I'm a business analyst. I don't do anything at all with investing for my day-to-day job. Investing is something I definitely do on the side for fun. I first got invested. My first investment, I was probably been about, it was in 97, so I'd have been 11. We sold all my savings bonds and I had my lawn mowing money, so I had $700. And I went with my grandpa to his advisor. I don't even remember who they even worked for. And we put that $700 in a mutual fund, and I never touched it or did anything with it. Looked at it periodically in the newspaper when I was younger. It was a Putnam Vista fund. And I ended up selling it in my senior year of college for, I think it actually ended up going up like 300% over that 15 years or whatever. So that was pretty cool. And that's kind of how I got originally into investing. My first stock I ever bought was in 2010, was Walgreens. I had worked there in the pharmacy when I was in college, and I just decided to buy shares one day in 2010, and it would have been great to hold on to that for a long time. But when I was 23, I didn't know what I was doing, and I just sold it for a small gain to have some money. So that's kind of where that got started. And then I've just been sharing more of my journey as I've went on in the last year and a half. It's pretty crazy how many people I have got to know along the way, and I feel like people are learning along with me, and so that's kind of what I've been sharing. And now I'm going to actually get into my investing process. I actually had this broken down into in 3 different parts, and if anybody really enjoys this, I can figure out a way to share it on Twitter as well. So I got it broken down into 3 parts: actual investing, which I'll talk about first, time and risk management, and then investing education. So I'll just kind of get going here. Generally, how it works for me is I'll learn about a new company, talking with friends and family, networking, something on TV, social media. Quite often it's from FinTwit these days. So what I'll do is I start out by just pull the company up. I use Yahoo Finance quite a bit since the last big Twitter event. I learned about Koyfin charts, and I've been using that a lot. That's great. So for the first example, I'm going to break down. I'm just going to use Etsy because it's a company that a lot of people know about. So I just go to Koyfin online. I enter the ticker. In the left ribbon, I click on financial analysis and then highlights. So for me, the first thing I look at is market cap, the size of the company in US dollars. I personally am pretty focused on small to mid cap companies. Generally, stocks generally I'm not too interested if they're below $5 a share. But sometimes I am. Generally, I'm looking at companies that are 750 million to 10 billion. I like that area because I feel that I can grow my capital exponentially. Of course, there's considerable downside as well that you need to think about in that area. But I feel like finding companies at this size oftentimes is early in the life of the company, and if you can find the winners early, you can get good winners going, and then you keep on learning. So once I understand the size, I then pan out to the sector and the industry. I think to myself, is this an area of future growth? Can I personally see it? What might the potential total assets or the TAM be, the size of the industry? Are there digitization opportunities? Is this an area that the future is poised to be a big winner? Does the company have a sustainable advantage? Is the company sticky? What is the company doing to separate themselves? And one of the last questions I asked myself is, can they be a true market leader? On my Twitter profile, the TML does stand for True Market Leader. I've been invested in most of these companies now for 2 or 3 years. And so that's kind of why my profile name is what it is. The next thing is, so a little bit about Etsy. Some things about this company that I really like that stand out is front and center, they give you the value proposition. And there's a couple of people on Twitter who have been breaking down their investments based on the value proposition that they see. And I really like that. And so I like to look at graphics about, what is this company doing to separate themselves? How are they engaging the consumer? How are they growing the business? Which direction is it moving? And where I find that is in the investor presentations, and I've shared those from time to time. Then I go to the actual company website. I like to play around, look at what is online. How do I feel about the site? Is it user friendly? I then go to the investor relations portal. I look at the presentations, the slides, and that's where I really dig in. I love doing company research. I use OneNote to journal all my ideas and to store data. And I've shared a couple different times my personal company thesis schematic, the 8-part breakdown of what I look at: profile, financials, press releases, the chart, competitors, about the company, hiring, and then just kind of how I conclude on that when I look at each company. So going from there, I then look at the financials. A couple of key areas that I look at first are revenue growth, year over year, and quarterly. And I think a sequential quarterly comparison is really, really smart to be doing right now, especially in this market. A year ago, we were in full lockdowns. And I think it's going to be a little tricky the next couple of years doing financial comparisons because of everything that has been thrown at us and what companies are trying to do. So I want to stick with companies that are growing revenue at least 30% year over year. Anything higher is great. Etsy really stands out to me because the last few quarters, they've actually been having super hyper growth, over 100%. So when we see huge changes in the revenue, I think it's prudent to look deeper at the cause of that. Does the narrative support this continued growth, or is it short term? Some of these companies, they're overpriced, they're overvalued. That's the noise we always hear. It can't go up any higher. You're buying this at this valuation. You're crazy. Well, you're not crazy if you're doing your homework. So next, I look at earnings growth. A lot of the companies I'm invested in are not even making any profits yet. So if they aren't, is earnings per share going towards profitable? What is the earnings per share growth? A couple of the companies we're seeing valuations for earnings to start hitting positive and then really taking off in the next couple of years. One I'm really excited about is Digital Turbines. As far as projections go, I don't really like much beyond 3 years. I think at some point it just becomes way too speculative. With the pace of innovation, it's really hard to depend on that far out of distant valuations. And then the next, I look at multiples. I like to use enterprise value to sales for the next 12 months, not trailing 12 months. And I also like enterprise value to EBITDA. My wife is a CPA, so some of the stuff I can't always figure out, and she helps me a little bit, which is pretty nice. I am not a valuations or fundamentals guru. This is where I'm spending a lot of my time now learning. And that's what I love about CoiFin charts. It's very, very user-friendly. So what I try to do is I try to compare companies in similar sectors. This can be tricky, obviously. I don't think that valuations necessarily need to be rocket science, but it is really, really important to be taking those into considerations because some of these companies are getting really, really richly valued. And I think the more you know about fundamentals and you can break it down, that's where you're going to find the real multi-baggers. So that's kind of to touch on that. So now I've decided to actually buy shares. So first and foremost, I understand how much money I want to allocate to any investment. and how long it should take me to get there. Some of my holdings, it takes me several months to build a core position size because I like to add over time as the story evolves. And I'm a big proponent of averaging up your cost. Rushing into position size in the short term can be costly, but really, the mindset of a long-term investor, we shouldn't be too concerned with short-term price movements, which is why I do like the dollar cost averaging method. So next, for charts, I look at the charts. I use Yahoo Finance because I've grown really comfortable with it. It's really easy, user-friendly. Personally, I am an active buyer when the market is in a confirmed uptrend. I don't really spend a lot of time looking at indexes, but since I'm a tech investor, I use the NASDAQ. How I go about adding, I've explained this to a few people recently. I like to add hard when the 5 SMA is above the 9 SMA. And to me, generally, that's pretty indicative of a confirmed uptrend. I add shares generally every few weeks, but if the market is really volatile, I'll look for companies that are getting near their 200-day moving averages. I won't just buy because it's near a level. I want to look for support. Is there a base being put in? A base generally can create pretty good support, or it might even pull back to support. So if you were to look at a chart and you don't know what support is, from a very high level, has the price been there before? How long did it stay there? I put on my indicators such as volume, and I look at those types of things, but this is a pretty broad crowd, so I don't want to really get into too much technical analysis. As they say, the longer the base, the higher into space. I think Kathy Wood started that. I don't know. I just started saying it a while ago because it made sense. I do spend a lot of time charting, looking at various levels. What is the price done? What is price telling us? What does the volume look like? Price action, buying, selling, it tells the story. Again, long-term investors shouldn't be too considered with that. But I am interested in learning all these particulars, and technical analysis is heavily involved in my process. I'm not a day trader. I haven't hardly been selling that much unless I found a change in the company or it no longer meets what I want to be invested in. And the reason I do that is because I want to make the best use of my capital. I made a couple of buys early in March, and they went way down from there. So I probably should have relied a little bit more on my homework before then. I think it's really important to have cash available, especially during corrections. But I usually am fully invested. You can keep in mind, even if you're fully invested, you can always sell. People shouldn't feel bad about having to sell or to trim. If you need to do it, you need to do it. It's your capital. And I never ever sell winners to add to losers. I used to do that in 2019, and that was horrible. It's really, really stupid. Stick with the company story. Don't grow complacent. I try to adhere to this thought process. Never make an investing decision for a non-investment reason. I'm going to run out of time, but I got a lot more I want to go through, so I'm going to try to chunk this down a little bit. Part 2 is time and risk management. Some people maybe read my Caleb's 2020 learnings that I still have on Twitter. I'm really proud of that, and I look back at that, and it helps me regain my backbone when I feel like, oh my God, I'm losing a lot of money. But remember, it's time frame. Fully understand your time frame as an investor. If you're truly investing for the long term, you shouldn't be concerned about short-term market gyrations. If invest cash that is not needed for 2 or 3 years. The longer out that is, the cash that you need, you can make more applications on bigger corrections. So if you were able to buy in the last correction, maybe it's working out. If you're a long-term investor, you don't need to sell even in a correction if you are invested in high-quality companies. And that's based on research and due diligence. For risk management, a lot of risk management as a long-term investor should be covered off already under your time frame. Do your own homework on companies before investing. You should never be blindly buying shares regardless of who's posting about it. Would you give your money to a stranger and expect them to have your best interest at stake? Avoid MOMO, which coincides with FOMO. If you are hearing about something on social media for the first time, it's best to review what price has already been baked in. Look for any future growth and earnings at the very least. If you can't do that, be ready to be very uncomfortable. This one here, know what you own. This is the keys to the Ferrari. Understand the business. Is what they do sustainable, or is growth only by acquisition? Get to know the leadership team and board of directors. The board is a glimpse into where the company is headed. I personally think that MongoDB has one of the best management teams and boards I've found. If you've never looked at MongoDB's board and management, do it. That company is awesome, and I don't even have any shares of it. What is the business strategy? Watch what the leaders of companies say, but most importantly, what they do. Know what you own should really be the core pillar for all individual investors, I think. This will give you a backbone on the reddest of the red days. When others are capitulating, you are prepared to stand tall and be buying. This has saved my ass multiple times. Most recently, when the short report tried to take down Magnite, and as recently as Farfetch with that hedge fund that blew up. I was buying on that Friday that news came out. Another tough one for me. I left a 5-bagger on the table with Enphase when that short report came out a year ago. I hadn't done my homework and I had been blindly buying that one, so that one hurt me. The last part I think is really important. It's about investing education, how to nourish your mind to make room for good investing habits. Learn how successful investors became successful. Peter Lynch would find ideas from his own family, where they shopped, what were the trends, patterns to take note of. One thing I found success in is TV shows where characters are doing or using things that we know very little about, excessive use of things, and making jokes about things that people are using. Some examples are from shows that have done this. Wonder Years, Saved by the Bell, and Modern Family. I found that if you had been paying attention to the trends in those shows, you would have had some very, very good investing findings. Where you can read about the career of these investors, Peter Lynch has 2 great books, One Up on Wall Street and Beating the Street. Robert Kiyosaki wrote a great book, Rich Dad, Poor Dad. Chris Mayer's 100 Baggers, and Morgan Housel's The Psychology of Money. If you haven't read any of those, they're great. Make sure you're reading both fiction and nonfiction, and definitely don't read just about investing in finance. The brain wires things really weirdly, and it does a lot of the hard work in the subconscious. Reading is, I can't say enough about reading and finding new things. So to wrap this up, for all types of investors, there's much more to learn than we have time for. But the younger we get started, the more time we have to grow knowledge and wealth. The key is the time frame. Whether you're a trader, swing trader, or long-term investing, the key is looking out and knowing what our goals are so that they align with the journey. Never put yourself in a position to lose it all. Always make sure you can take the field the next day. As they say, the sun will always rise, so be in a position to get back up no matter how hard you've been hit. And my last favorite quote is, don't miss the forest for the trees.
That last one's one of my favorites too, Caleb. I love it. So really helpful walking us through your process, I think, especially for anybody that's new to investing, getting a sense of how someone can go about their research and investing process is really helpful. So with that, though, I want to end with asking you the same question we've asked everyone else. What's one mistake that you've made in your investing journey?
Sure. I really think it is not having done proper research to understand what I'm invested in. And Fiducia made some really great points. A lot of people say that if you can't explain the company you're invested in to a 10-year-old, you probably shouldn't be invested in it. And if you keep it that simple, that means, do I know what I'm investing in and what don't I? Because I had mentioned a few companies I had invested in and I didn't know enough. And so it's making sure you understand what you're investing in so that, if there's volatility, you know what to do and you always have that plan.
Awesome. Yeah, no, I agree. Well, Caleb, thanks so much. Max, I'll turn it back over to you.
Yeah, absolutely. Caleb, thank you so much. Great talk. Thank you so much for being a part of this. Really appreciate it. Keep spitting fire and feed with the community. You're the best. Thank you. With this, I would like to turn over to our next speaker, Wolf. Gav Blacksburg was previously Goldman Sachs and now is CEO, head of strategic partnership and chief Twitter user of Wolf Financial. He's the host of Stock Center and the Weekly How on Twitter Spaces. One of them, my main competitors when it comes to Twitter Spaces. I know it's not really all about the competition, but I really enjoyed connecting with him, learning from him. And on a quick note, he was instrumental in helping this event come to fruition. All the designing graphics it's all about his team. Thank you so much. The floor is yours, Wolf.
Thank you so much, Max. And before I go, Caleb, you were just spitting fire. I just wrote like 4 or 5 tweets, just quotes that you were saying. Honestly, I couldn't stop. Just kept it going. So if you want to see some of those quotes again, just reread them, refill that magic. Go check those out. Also, before I go, there's so many amazing speakers on here. I know that we can get a bigger crowd. There's so many that are coming after me. If you haven't shared this event yet to your page, just go ahead and hit that share button on the bottom of Spaces. Share that out. Let's get everybody in here to learn because we're just educating so much. And you know, I'm pretty young, so I'm learning a ton from all these guys who have far more experience and knowledge than I do. But a little bit about what I'm talking about. I'm talking about financial communities because those are my passion and what I have set out to build. So just a little bit of background. Max just said I worked in PWM for a bit at Goldman Sachs. I also worked at a PE shop for a little. I have a bachelor's in finance from Drexel University, and I work full-time now as the COO and a number of other positions for Wolf Financial. So I do want to talk a little bit about what Wolf Financial is today because when I use this Twitter account, I speak from first person pretty much always. I had that ability going in to create it where I was going to say, do I want to be a brand and talk brand talk, or do I just want to be myself? And I chose to just be transparent and be myself so I could post things like, oh, my return was this today, and not say, how is everyone doing, and just the brand speak. And that has progressed really well. I've built so many powerful connections on here. But what is Wolf behind that, and what is my life passion to be building, and you know the 15 people that are on the Wolf team building behind that. So just to kind of talk to what it is. Sorry, just flipping through a couple of notes. Essentially, about a year back, I was getting a lot of texts from friends. This was last March, and I'm sure that everybody can relate. We were seeing the market start to crash. And a lot of my friends started reaching out to myself and a friend of mine named Ben, who is now my CFO for Wolf. And we were getting texts along the lines of, the market's crashing, what's going on, the classic, fix it, please, right? Because we're the stock guys. And we realized that there was a two-pronged problem here. The first was so many people felt like they were alone. They felt like they were the only person who was losing that amount of money. And that's because they didn't have a community like this. They didn't have a place where they go and chat every day about, oh, Red Day, what are we buying? They look at their stocks and see Red Day and go, oh my God, like I can't buy food this week. It's just that feeling for some people. And they just could not comprehend that other people were losing money with them. And then the second problem was we were getting texts like, I have Facebook, I have Google, I have Amazon, they're crashing. Should I be selling? And my response to that, just like I'm sure many of the speakers up here would say, is have the fundamentals changed? And we would get the question back, I don't know. How do I find that out? And these are people that are not finance majors, so I don't fault them at all for what they said next, because I would reply with saying, you should probably go read the 10K. And they would reply saying, what the fuck is a 10K? So after that interaction happened several times, myself, along with my friend Ben and our CEO, Michael, realized that we needed to change this and we needed to build a home for our friends and a community, as well as completely rethink financial research. So we've been working on for over a year now is the Wolf app. And the gist is I'm a Twitter addict. I love Twitter. I spend like 10 hours a day on Twitter. It's ridiculous. It's part of my job now. But I think that there's a lot of ways that Twitter could improve if you're looking at it from a financial perspective. For example, when I click on a ticker or I see an amazing, someone posts, let's say Chris makes a post and he's like, KLIC, free cash flow up 100% this year, and they're pouring out this product or XX and X. And I'm looking at it going, that looks so good, but I have no idea what this company is. And I click on it on Twitter and I just get a list of an aggregate of data where everybody is tagging a specific stock, but I'm not actually seeing real data. I don't see the price of it. I don't see the fundamentals. So what we set out to build was the Wolf app, which is a social media built for finance. And that is when you go in and you are seeing a stock and you want to know more about a stock, you can do the full fundamental research inside of our app. We've actually partnered and we have signed contract with Seeking Alpha. We also are partnering with TradingView and a couple of others to bring in a lot of this data that you would need. And we completely rethought financial analysis because to somebody who's not a finance major, reading a spreadsheet or a balance sheet, income statement, 10K, it's not going to happen. It's not natural. It's not what they want to do. So how do people learn something new? Pictures. We're visual learners traditionally. So we have taken all that data and completely manipulated it in app so that you can go and instead of having to see a series of numbers for the balance sheet, we've turned it all into graphics and pictures so you can easily understand it. And my favorite part is about the Wolf app is as you do your research, you are creating content. So when I go in and I want to find a free cash flow graph, let's say right now on Twitter, I wanted to post a 5-year free cash flow graph for Netflix to show that they finally hit free cash flow positive. I go to Yahoo Finance, I download 5 years of data. I go to Excel, I calculate free cash flow, I make a shitty looking graph because my Excel skills aren't that great. And then I post that into Twitter. Now, if anybody wants to learn more, that kind of shit out of luck because it's not dynamic. And also, that's a lot of work for me. That's going to take time. In the Wolf app, I can go into the stock, pick the stock that I want, hit finances, scroll down, free cash flow graph is right there, select the time period, 5 years, share right in. Now, some of our stuff is in beta. This is actually an internal testing. However, these features should be out within literally a month. So I am so excited, and that's what my passion is. Now, when it comes to Twitter, I just want to speak real quick to what my goal is on here. My goal is just to unite this community. When I saw Twitter Spaces, I just could not believe what this opportunity was. I wasn't given Twitter Spaces with the golden ticket like Max. I had to fight for it. I went to Twitter Spaces. Please don't do this because then they're going to get mad at me for giving secrets. I went to Twitter Spaces. I went to the people that they follow. They only follow people who work at Twitter, and I just went down and DM'd them until somebody gave me the ability to host Spaces. So that was kind of my thing. And now I talk with like 3 or 4 people who work at Twitter a day. I get feedback, all that type of stuff. But the goal for me and why I went to that extent was I love bringing people together who are much smarter than me. Basically, every speaker on this list probably does better stock research better than me. Their portfolio probably performs better, all of these things. But if I can aggregate them and I can learn from them and I can take notes and continuously hear from them week after week after week. And now I'm holding 3 spaces a week, 5 spaces a week, podcasts, interviews. Listen to my podcast, listen to my interviews. I'm subtle with my analysis. I don't go deep dive. I let my guests do that because I am here to absorb. That's my purpose for this next year or who knows how long it takes for me to build more of a basis. I'm being a sponge. That's what they told me. I think day one at Goldman Sachs. They said the most important thing you can be is a sponge. We're going to hit you with. They love saying this. It's like drinking from a fire hose when it comes to this information. But that experience hasn't changed. Twitter's like drinking from a fire hose. I mean, I tweet 100 times a day, but how much content am I intaking? So to me, I'm just passionate about building this community further. Creating the best spaces, bringing all of this and really democratizing it because the best part is this is all free. And that is just my goal as I continue to do this. And I know that this week we're having amazing spaces. Just going to drop this in here because we're on this anyways. I'm going to have a big space tomorrow night moderated by Chris himself talking about semiconductors. I have another one on Wednesday talking about Market Madness. I have another one on Friday. Might get Brian Feroldi back on that. Mukund will be on there. And then next Sunday, we're doing this all again. We have a fantastic, stuff. And I'm sure Max will speak more to this series that we're doing. But I am just passionate about this. This is what I do all day. I'm so blessed. This is my job, my full-time job. I work 7 days a week. I don't take off because I really love what I do. In fact, this morning I woke up about 3 hours early because I couldn't even sleep. I was so excited to listen to people and learn from them. I have Josh Meltzer, one of my analysts on here, taking notes. And I think that is my time. So I'm going to close it up there. But I'm just super grateful to everybody that's coming and listening to these things because that's what makes this passionate. And I can't wait to continue to build my audience. The response from Twitter has been amazing. I had 2 months ago, I had about less than 200 followers. I cracked through 3K last night. So it's moving fast. And, these are all just people that I don't even know if, I don't think it's necessarily my content. I think it's the content that I bring to them. So my pledge to anyone who's part of my community, my followers, is you're not just going to get my content. You're going to consistently get the best content on the internet from a lot of mine and your favorite creators. So with that, I'll turn it back to you, Max.
Gab, that's awesome. I think that you've been a very strong presence, I think, in the Twitter community lately, and everybody's benefited a lot. I think that the market event itself has been a lot of fun. So I'm going to kind of mix it up a little bit for you. I do want to know what your biggest investment mistake is, but I also want to know, and I think this would be helpful for a lot of people too, what's been one lesson that you've learned, building a business?
Absolutely. Fantastic questions. I have not had a ton of time to make the big mistake yet. I've been investing for about mm, investing really about 2 years now. With more actual money, I was doing a lot of portfolios for a few years. My biggest investment mistake, probably not being concentrated enough. I get super excited when I see new names and when I see people in my community getting passionate about something. And I think I'm decently easy to convince that something might be a good investment. And I think I need to hone down on that. So I've been doing better with that in my Roth, but I do have just a traditional active, and there's just too much stuff in it. So listening to some of these past speakers really kind of gave me some clarity as well. I think I might do some cleaning up this week. But yeah, just having too many names in there, just being too easy to convince that something's a good investment. I need to take a little bit more time on them. And then from building a business, it's insane. I think I learned more in the past year building this company than I did in my 4 years of undergrad, honestly. I learned how to distribute equity, write papers, hire people. I guess that would be the biggest lesson that came from this. So I do all hiring for Wolf. I've interviewed probably about 30 people at this point. We have had interns, we have full-time people working for us, developers, designers. The biggest thing that I've learned is that there's nothing more dangerous than a wrong hire, than a bad hire. It can just go wrong in so many ways, unfortunately. It's tough because they're not doing the work right, and you have to then lend from yourself to that. It's tough to remove them from a company because people become ingrained in the culture. So I think that taking your time at the beginning of a startup, because our first few months on Wolf, all of our friends were like, wow, this is so cool. I'll come on as an intern. I'll work for free. We'll figure out the pay later. And a lot of those people aren't around anymore. About 4 or 5 months in, we realized, okay, we need to cut some of this weight because people weren't working. They were just doing some side stuff. They weren't committed. They weren't passionate. They weren't into it. So for me nowadays, when I go to make a hiring decision, there's multiple rounds of interviews for someone to come on. I really go into their background. I talk to other people sometimes that will know them. Just really try to get an understanding. And also, I think I'm more upfront in the interviews as well. People used to come into interviews and it was a very, relaxed interview. It was, this is a startup. You're going to have fun. You're going to be able to work your own hours. And now I'm like, you're going to be here. You're going to be here. You're going to do this. You're going to do this. And we're going to be successful. And that's kind of a lot of what I've learned. So thanks, Chris.
No, of course, and thank you. I think it's really helpful. You're the general, just directing the troops. Wolf, thanks as always. Always love the energy. Max, back to you.
Yeah, absolutely. Just like Chris mentioned, you did a phenomenal job with this presentation. Thank you so much for bringing the entire FinTwit community together. And I just wish that my portfolio would be growing as fast as your followers count. And I guess it's just another example of it's like sort of like a testament that you've been doing a great job bringing this awareness to the entire community, hustling day in and day out. I'm really fortunate to know you personally, and I'm really looking forward to all the future events and whatever we want to do together. Thank you so much, brother. I really appreciate it.
With back at you.
Yeah, absolutely. With this, I would like to turn to our next speaker, Nick Greene. He's a private investor, also writer at Black Tie Investing, which provides market commentary, business psychology, and stock picks, as well as capital canvas. His goal is to discuss companies and their future prospects, to look at human psychology and its impact on financial markets, and to examine developments and current trends in the world. I'm really interested to listen to your presentation. I think psychology and investing, it's one of the areas that I think overlooked by a lot of retail investors, and I'm really excited to learn from you. Nick, the floor is yours.
Well, thank you, Max. I just got to say I'm very impressed so far with the whole presentation, and one of the areas that I think is going to be very investable in the next 5 to 10 years is education. And some of the best advice that I ever got early on from a guy that I really respect is, everything that you need to know to be very good at this is free. And I think that that's very important for new investors to understand. It can be very daunting. You're getting hit from a lot of angles when you want to learn about investing, markets, psychology, and business. And it can be tempting to think you need to shell out your wallet. But it's actually the opposite. It's totally dependent on you and your willingness to learn. So big shout out to you, Max and Wolf and Chris, for putting stuff like this together, because this is what helps build people up to basically change their life. So happy to be here. I want to start off. I think people know about the common biases in investing. We've all heard of them: confirmation bias, things of that nature. And I kind of wanted to bring a little bit of a different angle, just as far as common sense thinking, as far as your own psyche towards investing. And I'm going to start off with something that I consider to be somewhat of an interesting paradox. I think everybody that's here, I don't know if type A is the correct word, but we all set goals for ourselves. We're all here because we think we can do better than the market. We think we can do better than average. We think that we can take our finances into our own control instead of just putting it in a 401k. And the problem with that is that the people that are drawn to markets like us, that think we can do well, are the exact kind of people that basically get punched in the gut by the market. The market hates people that have any sense of greed or overconfidence. And these are easy things that you can succumb to in the beginning. So I think the best way to guard against that, and this is something that I did in the beginning, is to basically slow down your action. If you're somebody who's excited about investing, you're excited about a company, digging into it, do everything you can to slow yourself down. And some advice that I can give is that I basically had a little book, a journal, a 3-ring binder actually, and I wrote on it, portfolio, add diligently. And I basically forced myself to write a couple pages of report on qualitative factors of the company, the management, go through the finances, and even go through completely mundane and things that I thought were irrelevant, just to slow myself down. Kind of like Brian was talking about, he started off trading. I started off trading, and I got my ass completely handed to me in that front. And that slowly evolved into investing, which I've had some success in. But I really think that people coming into the market, they're driven, they have goals, they think they can do better than the average, and there's nothing wrong with that. But that mindset is going to cause you problems. You have to unlearn that. You have to humble yourself, and you have to have a certain level of intellectual honesty. Going back to concentration too, as far as portfolio management and construction, if you're analyzing, say, 1 or 2 businesses pretty deeply a week and looking at them, if you think you can invest in 25% of them, I think you're not being honest with yourself. I really think that you should be limiting yourself to 3 or 4 really good decisions a year. And that's very, very hard to do. And I think one of the best ways to guard against risk is to be intellectually honest with yourself. And that is just something that comes with experience. I run into great companies all the time that I find interesting. But at the end of the day, you have to look at yourself in the mirror and say, do I have an edge at thinking about this company better than other people? Is there something that I bring to the table that other people don't? And that's just something that comes with experience, and you got to give yourself time. I like to say that your investment strategy should fit you like a tailored suit or like a glove. It's process that matters. You have to understand your own process. And personally, I did not decide to be a long-term investor. I came into this hot-headed and thought that I was going to be trading up and down and making a ton of money. The market basically beat me down and molded me into the strategy that I have now. So I think looking at strategies and looking at how you're making decisions, I recommend letting the market mold you as opposed to trying to force your way into some sort of system. So that's where I wanted to start off. Obviously, there's a good Jesse Livermore quote. It was never my thinking that made the big money. It was always my sitting. So this kind of comes back to having discipline. There's almost no other profession out there that pays you to sit on your ass and do nothing and make a few good decisions. It's very hard to understand, especially when you see the amount of money people are making, posting their returns, Twitter, whatever else you're looking at, Reddit. It's very hard to just sit there and do nothing. And as much as I like Cathie Wood, and I think she obviously has a bright future ahead of her, the reason Buffett and Munger are still kind of in a category of their own is because no one has been able to sit on their ass for decades, completely ignore the tech bubble, and just focus on what they're good at, know their circle of competence, and have intellectual honesty. And I hope Cathie Wood, does well, and she's able to do that. But that's sort of why Buffett and Munger are outliers, is because their principles have stood the test of time. So intellectual honesty is a big one. Now, going back to being robotic, this is something that you hear a lot. Be unemotional, be robotic. Don't listen to your emotions or your gut, your feeling and things like that when you're making investments. That is true, but I personally had a hard time with that. I'm human, so I kind of decided to reverse engineer that. The way that I go about this is that instead of trying to be robotic, what I do is I try to listen very, very intently to my emotions. When I am feeling sick to my stomach and the last thing I want to look at is a chart or the quoted price of a stock, that is when I try to buy. When I'm scrolling Yacht World looking for the next boat that I want to buy and feeling like, I'm on cloud nine, that's when you should be selling. So instead of trying to be robotic, I would encourage everybody to sit back, read your own emotions. You know how you're feeling, read your own emotions and act against them. That's something that I've implemented that has worked very well for me. If you aren't scared when you're buying, you probably aren't buying in a generational opportunity. I mean, obviously these things don't come around often, but if you aren't a little bit scared or a little bit nervous, you probably shouldn't be buying. You really want to be operating in a small pocket percentage-wise of investors, transaction-wise, when you are buying or selling. You do not want to be moving around with the herd. And when you're moving around with the herd, decisions are easy. When you're moving against the herd, decisions are hard. So my advice is read your own emotions and act against them. If you're having a problem being, robotic, I think that's a bit hard. Now, looking at businesses, this is an aspect of psychology that I don't think gets talked a lot about. People always talk about decision making and biases, but there's a certain psychology to looking at businesses, especially looking at modern businesses that are involved in technology and have limitless leverage. We've never seen companies that have as much leverage as they do these days. So I wanted to touch on that because everybody's constantly talking about, I'm a value investor or I'm a growth investor, yada, yada, yada. Growth is value and value is growth. Those two things are interchangeable. Munger always talks about how all good investing is value investing. The future return that you're going to get on a business is what the market and other investors have not yet considered that may happen. That's what value is, and that's what growth is. Now, if you get there by looking at companies with high growth, that's fine. If you get there by looking at cheap companies, that's fine too. Not really. I made a quick thread about this. Back in the old days, the markets were less efficient. You could run the numbers. You could find businesses that were trading cheap in regards to their intrinsic value, buy the gap and wait for the market to close it and sell out. It's changed a lot today. So when you talk about value or growth, nowadays with technology in these companies, you want to invest in ecosystems that can produce amazing things through technology and innovation. So a company that I really like is Square. I've been pretty publicly bullish about Square. And people will talk about it in the fintech space and compare it to PayPal and things like that. But if you look at Dorsey's mission, if you look at what he's trying to go into, Square has the possibility to operate over a plethora of industries, and therein itself lies the value. It's like when Amazon was at $700 a share and it had a PE of 200. Of course, it wasn't statistically cheap, but if you were able to have creativity and think about the areas that Bezos could drive that monster company into, that he could push it into, all those opportunities were sitting in the future, but people weren't thinking about that business creatively like Bezos was, and that's the value and that's the growth. These things, they're in the air, they're qualitative, they're hard to nail down, and as the markets get more efficient and more people participate, you're not going to be able to look at revenues and balance sheets and find a company cheap comparative to intrinsic value. You have to think long term about how a company can maneuver itself into new industries and new opportunities. And the best case example for that is Amazon. It's, they went from selling books to selling everything. Could Square go from that little point of sales, to again, everything? I think that they probably could. So I think opening up your mind and thinking creatively about companies and really thinking like a founder, having a mission, is very important. I have a really good quote here that I'm going to end on from Mark Anderson, and I hope that it kind of opens up your guys' minds as much as it did mine. So basically the quote starts off with, the core idea we have, the core theory we have is that fundamental output of a technology company is innovation, and that's very different than a lot of businesses. The fundamental output of a car company is cars. The fundamental output of a bank is loans. The fundamental output of a tech company is innovation. So the value of what you've actually built so far and are shipping today is a small percentage of the value of what you're going to ship in the future if you're good at innovation. So the challenge tech companies have is if they can never rest on their laurels with today's product. They always have to be thinking in terms of the next 5 years of what comes next. And if they're good at running internally and are indeed a machine that produces innovation, they tend to do quite well over time. It's when things go wrong internally that they stop innovating, which happens a lot, that the wheels at some point tend to come off. So psychologically thinking about businesses, when he says, that a car company produces cars or a bank produces loans, I think as markets evolve, and Kathy Woods is, again, sort of a good example of somebody who's investing in the future. As markets evolve and these companies have so much leverage, they have the tools they have, the minds that they have is so advanced, we're going to have to start really opening our minds to the possibilities of what these companies can do. And I think there lies the true value and growth. So with that, I'm going to end. This has been fun. This was actually my first spaces ever. Hopefully I will be back and we'll be participating in these. But again, thanks guys for including me, and you're doing a great job.
Well, Nick, that was a great first appearance on Spaces. We had Morgan Housel be the keynote for our FinTwit Summit, and it's very important for people to understand that psychology is really one of the biggest driving factors, I think, of returns, especially because humans evolved to develop senses that really run contrary to what makes a good investor. So I think this was really helpful. So asking you, the last question that we've asked everybody else, what's one big investing lesson that you've learned in your journey?
Well, I appreciate it. And yeah, just to touch on what you said real quick, it's not that the market beats you. It's that you beat yourself. You have to get out of your own way. And that'll help a lot. Big mistake. Obviously the selling is very hard. We've touched on selling a lot. Something that's close to that. Really good businesses do a good job at making you think you're late. So I've had some massively missed opportunities because I found something and I didn't creatively think about the future like I was just talking about and really envisioning what, the guys managing the company were. I found Shopify at 90 and said, oh, this thing's gone. I missed it. And there's countless opportunities like that. So don't let the price affect what you think about the company long term. Think about where the company is now. It's never too high to buy and it's never too low to sell. That is a truism in markets that is very hard to come to terms with, but that is always the case. So whenever you see a company and you think you've missed it, think again, because there's people hard at work that could possibly make you a lot of money.
That's a great quote. Great companies think that you've already missed it. Wow. I love it. That's a great way to wrap up your session. Max, back to you.
Yeah, absolutely, Nick. Thank you so much for participating in the event. Like I previously mentioned, psychology in investing, it's very, very important. I think it all starts with psychology and it all starts in your mind, and then we'll go from there. So great presentation. That was quite a debut for you on Twitter Spaces. So thank you. And let's move forward to our next speaker, Brad, who was born and raised in Michigan. Now he's getting his graduate degree from the University of Michigan. Brad writes articles for Motley Fool and also contributes to Two Chat Money podcast on a weekly basis. He's passionate about long-term investing and constantly learning how to do it better. There is nothing he enjoys more than seeing his insights making other people money. Brad?
Yeah, thank you for having me. Tough acts to follow for sure. Great job, everyone, so far. So switching gears just a little bit, my talk is on American cannabis, so more of a sector-specific talk. And before I go into any of it, it's vital to know that this is still a federally illegal substance, and for that reason, the companies I will be talking about are not listed on any American stock exchanges. It's a little weird because at this point in time, if you are an American company and sell in America, you are listed in Toronto. But if you're a Canadian company and sell in Canada, you are listed in New York. And that's just a sign of the times we are in. Two more things. When I say MSO, I mean multi-state operator in the American cannabis industry. And then just know that I'm very much so a cheerleader for this industry, an advocate for legalization, and American cannabis is one of my largest sector weightings. So I'm for sure biased. And then without further ado, American cannabis. So the market, as of right now, American cannabis in 2020 realized $20 billion in analyzed revenue. The total addressable market is $100 billion. This rivals beer, which is about $110 billion. But when you pair that with a 10-year compound annual growth rate of 20%, things start to get pretty exciting. It's a large industry, very much so in the early stages of growth. So to give you an example of kind of the absolute and relative value, I'm going to throw a lot of information here on one company, but just know that this pattern holds true for American growers. There is a lot of relative and absolute value here, in my opinion. So Cresco Labs, which is one of the multi-state operators that I own, their compound annual growth rate from 2020 to 2022 is expected to be 57%. They're running at a 55% gross profit margin, a 33% EBITDA margin, 13% cash flow from operations margin, and they traded about 19 times EV to EBITDA and 6 times sales. So in the markets that we're operating in today, in the world that we're living in with ultra low rates and liquidity everywhere, there's really not a lot of options that give you this kind of growth at a reasonable price. And again, looking at companies like Air and Trulieve and Green Thumb, the pattern reigns true. And the growth, encouragingly, is not slowing down either. So this is information out of Air's, or a company named Air's recent investor presentation. They are 5 years into legalization in Nevada, and their same store sales are still growing in excess of 20%. And this is despite COVID-19 disrupting Las Vegas travel. So the momentum for growth in this sector is very strong and very durable. Another just really interesting tidbit from Air, they're growing quarter over quarter 33% on their sales per square foot. So it's not just a matter of building more stores and expanding a footprint, but the existing assets that these companies currently have are also in hyper growth mode. And beyond the organic growth, all these companies with the strong balance sheets and the farthest reach are aggressively stapling on accretive assets at 1 to 5 times EBITDA, just as a general range. And when a company like Cresco, which is pretty common, trades at 16 times or 19 times EV to EBITDA, there's a lot to like there. So as you'd kind of expect, based on how I've spoken so far, the growth in Canada is slower, the margins are thinner, the shareholder dilution and use of goodwill is much more aggressive, but still there's a valuation premium. So as a whole, multi-state operators in America trade at about 2.5 times EV to sales, while their Canadian LP partners trade closer to 10 times. So there's a large valuation gap that should, in my mind, be remedied. And here I'm going to kind of highlight some of the things that could take care of that. So legalization momentum as a whole is extremely strong. The support is bipartisan, unlike almost every other issue we have in our country. So there's 68% support among Americans for federal legalization. So based on this, it's not really a surprise that we're seeing states like New York and Governor Andrew Cuomo expedite legalization. The people are saying they want it, and the pandemic is requiring it. I mean, states' budgets have been decimated, and this is how you raise money, and this is how you create new revenue streams without raising existing taxes and creating new economic headwinds. So the risks, or actually, here, let me go down to some more regulatory timelines. So how I kind of see this is something called safe banking is extremely likely, and I'm expecting it later in the year. So what this would do is allow the companies like Cresco and Green Thumb and everyone growing in the United States to uplist into the New York Stock Exchange. And what this would do is greatly reduce these companies' cost of capital, which would be a strong margin tailwind. And it would also allow for institutional support, which is interesting. So I think personally, the main root of this valuation headwind is institutions like BlackRock and Vanguard, and these companies can't really access companies trading on the Toronto Stock Exchange to the same extent as they can on Aurora Cannabis that trades on the New York Stock Exchange. So the institutional support is stronger for Canadian names at this point in time because that's where the institutions can invest. So if this safe banking and uplisting comes and the institutional buying can start to pick up, there's very real reason to think that this valuation gap can kind of go away over time. And just as kind of a hint, the very first taste we had of the first American pot grower listing an IPO for American institutions to buy. So Green Thumb did it a few months ago, and it was oversubscribed in in hours. There's rumors that it was scooped up entirely by BlackRock, but I have not been able to confirm that. So if I can, I will definitely share it with the FinTwit world. And then another regulatory headwind that is, or another regulatory event that could be very promising for these companies is something called 280E reform. So what 280E is a tax provision preventing American growers from deducting any ordinary business expenses. So for me personally, I own Cresco Labs, Green Thumb, and Air, and it cut all three of their net income and free cash flow margins in half for 2020. So kind of quantifying a 280E reform, what it would mean for certain companies. So right now, Green Thumb trades at a trailing price to earnings of 62 times. If it had been reformed in 2020, it would be more like 36 times. Cresco Labs goes from 91 times to 42 times. So there are massive, massive events that can happen for these companies that really, really boost the underlying profitability to go along with states that are very much so in legalization mode. And then now that I've kind of gone through the exciting opportunities, I would be, it would not be okay if I didn't discuss the risks. So for sorry, the first one is it stinks having exposure to politicians. So it's something I generally like to avoid, but here it's unavoidable, and it's just something that I kind of palate. With all this growth and with the impressive margins and with the legalization will come more competition. And with that competition, cannabis will become more and more commoditized over time. So price per gram in states like Colorado and California that are several more years into their legalization process are realizing lower price per gram, and the gross margins for those companies operating there is smaller as a result. So it's interesting to kind of juxtapose that with the 280E reform and with the lowering cost of capital, because over the next few years, we could see gross profit margins and operating margins stagnate, while net income and free cash flow margins are greatly benefited solely from legalization. A couple more risks that we should talk about. An opening of the Canadian-American border via federal legalization that would allow large supply gluts to enter the United States and would also have an effect on price per gram. Now, in terms of likelihood of regulatory events, safe banking, 280E reform, and more states legalizing is extremely likely. Federal legalization is less likely. Interstate commerce being opened up. So, for example, Michigan can't sell to Ohio right now. That's a little less likely. And the least likely outcome that I see is international borders being opened up, because the politicians who are being tirelessly lobbied by all of these, by the executives of these companies, know that opening up the borders would be detrimental to these companies potentially. Now, what it looks like is going to happen is Canadian growers are going to be forced to enter the United States whenever they're allowed to via M&A, just like Canopy Growth did with acreage holdings. And not a whole lot of Canadian LPs have the balance sheets to do that other than Canopy. So I've said a lot. I've given you a lot of information to kind of think about, but it really boils down to two things. The legalization momentum is going to continue powering really high top line growth for these companies for the very long term. And more complicatedly, there are several margin headwind and tailwinds that are kind of existing simultaneously. We went into a bunch of them, but what this means, I think, is the companies are going to continue realizing this fast top line growth. And I do think gross profit margins and operating margins and EBITDA margins which look really impressive and are expanding very quickly. The expansion will probably continue to slow down, even if free cash flow margin and net income margin continues to expand. So I'm going to kind of wrap it up with more speculative and exciting use cases of cannabis, which I really like to research the plant and the use cases. So I'm going to nerd out here a little bit. So beverages, which companies like Green Thumb and Cresco are releasing, infused with THC, are said to emulate the effects of a beer without the calories, without the carbs, without hangover. To be candid, I have tried a THC beverage, and well, the effect isn't identical. It is pretty darn similar, and the value of being able to enjoy an elixir that kind of emulates beer without a hangover, I think that value kind of writes itself. And in terms of cannabinoids, so the main chemical that gets all the attention in cannabis is THC, and that's the thing that's making you feel good. It's the thing that's getting you I'm using air quotes high. But there are several other cannabinoids that have more therapeutic and more therapeutic use cases. So starting with CBD, there's strong support for anti-anxiety and anti-inflammatory properties. And the FDA has been extremely slow to acknowledge this, but it has approved a CBD-based drug called Epidiolex, which is owned by GW Pharma and Jazz Pharma. And there's a lot of data pointing to cannabis legalization reducing opioid addiction. So CBD and THC, that kind of combination having a very strong impact on lowering opioid addiction rate. The other two that are very exciting, and this is kind of these are longer term speculative use cases. One is called CBN, which is an oxidized byproduct. Apparently, or not apparently, it has very strong sleep applications. So there's a lot of thought that this chemical is going to continue to be concentrated and fermented into something that can be kind of boiled down into maybe like a ZQuil that you would take, and in 10 years that might not have drugs that are currently in it, but it might actually have CBN, which is exciting. And the last one is CBG, which is an appetite enhancer, which has several use cases for people with anorexia and other eating disorders. So ton of information, very exciting times, very quickly moving, and kind of how I would play this if you don't want the exposure to specific names is looking at an ETF like MSOS, which gives you broad-based exposure to American cannabis. Or if you want that Canadian exposure, maybe CNBS, which Tim Seymour, who's on CNBC a lot, pumps, which is a mixture of the high quality American and then also some Canadian names. So yeah, that's what I got.
Love it, Brad. Always really detailed, insightful. You know, you're one of the people that I really enjoy reading your work, because you really do dive into the details and do great work. So appreciate that overview, the verbal overview of the cannabis space. And I think it's interesting too, because, you know, a lot of I think the tailwinds just point to the regulatory environment really easing up. So I think it was good for people to start really getting their heads wrapped around the space. Going to ask you the same question as we've asked everybody else. You know, what's that one investing lesson that you've learned that maybe you can impart some wisdom on everyone else?
Sure. And first of all, just ditto. I very much so appreciate all the work you put out for Twitter. I know a lot more about semiconductors and lasers because of you. But
Lasers are
in
great.
terms of advice, yeah, I would say do what's good for you. So you're hearing a lot of different philosophies, and you're hearing a lot of different styles for how people go about building their portfolios and saying what they think works for them. And I'm sure those things do work for them. But investing is not at all a one size fits all approach, and kind of through a process of trial and error, or ideally trial and other people's errors, you can kind of figure out what risks and what kind of and what parts of investing that aren't as fun you can palette, and use that to kind of craft the philosophy that you want to use and you want to apply to your investing process. So I take tons of advice from people like Warren Buffett and Peter Lynch and Charlie Munger and Chris Seifel and all these brilliant people, but I don't fully copy them. I just emulate them and kind of tweak it in my own way.
I think you just committed blasphemy of some sort.
That was intentional, just so you know. Yes, I did put Christopher Seifel on that list.
I was kind of dozing off, and I heard that. I was like, "What? That doesn't belong." Brad, thanks so much. Max, I'll turn it back over to you.
Yeah, sure. Brad, thank you. That was a phenomenal presentation. I always love reading all of your articles that you post on Motleyful website, or all of your newsletters or due diligence and threads on Twitter. Thanks for all of your contributions. And I'm really glad to connect with the fellow Ozonian. So thank you. That was great.
Thanks for having me.
Yeah, absolutely. So just wanted to say a really quick thank you so much for all the listeners and speakers. This event would not be possible without all of you guys. So I'm just trying to bring as much value to all of you guys, and thank you. We're approaching approximately half of the event. Thank you so much for hanging out with us. Yesterday, during one of my posts about a final reminder of this event, Financial Fitness, I said that we're going to have a special announcement. And once we get into the specific industries right now, I would like to make this announcement. As I mentioned during my introductory speech today for Financial Fitness event, which is still going on, and thank you all of you guys so much for being a part of this. We're going to have multiple chapters. they will follow today's. Right now, I would like to share with you guys that the next Sunday, on April 18th at 2 p.m. Eastern Time, we'll be releasing the first chapter of Financial Fitness called E-commerce and Marketplaces. Some of the guys that you hear right now will be on this event as well, and I just